rules are please ask us questions. I mean, this is why we do it. Don't feel bad about badly. If if you're following proper grammar, it would be don't feel badly about interrupting us. And if you would just mute yourself, I can do it, but while we're talking, because there can be background noise. Okay, with that, by the way, I'm Tim Quast. Nice to see you. And now I'm going to hand it off to Brian Wilson, our market strategist, for part one. Over to you, Brian.
Perfect. Thank you, Tim. Hey, everybody. Great to see you today. I hope you are all doing well. I have a lot of just kind of quick snippets, quick topics today. Some of them will be review, but it's good for us to review. If you're anything like me, it's easy to forget things, and then especially for our new users, we want to make sure that that you get the best that we can provide. So I'll go ahead and share my screen, and we'll get started. Once again, great to see you all. And I'm going to start with what we call the daily trading ideas. And as an investment community, as a trading community, we love your ideas. We love what's working for you. I'm just going to share what I do. Tim does something somewhat similar, but daily trading ideas. It gives you the momentum and low volatility portfolios there, or names. You can see that there's 18 names today in momentum, and there are 8 names in low volatility. So what I will usually do is I'll just sort this by probability. And when you sort it by probability, it actually brings up sorting by volatility as well, which is kind of helpful. And I'll walk through that here in just a second. And then I just take the names and I'll take the top ones. I won't take them all. I think I went down to STX today. And then I'll just drop them in a watch list. So my watch list looks something like this. There's that top one that we were just looking at. You can immediately, one thing that immediately stands out, that's under a lot of pressure today. And what I'll do with these names, every once in a while, I'll trade intraday. Usually I'm trading the last 10 to 15 minutes of the trading day. If I was going to trade intraday, what would it look like? Well, this name, I didn't have time to really unpack it earlier today. I think it's a uranium play, if I remember correctly. But it was down all of its volatility. So if you look at daily volatility, about 12% here is recent trading. And what that means, it's the average movement from lows to highs during the course of a trading day. So there's a lot of volatility in this name. I think we got as low as down about 13% at one point, and it's been bouncing around since then. What I'll do if I'm going to trade, especially intraday, and I'll do it at the end of the day as well, I'm going to look for look for news in the name. If I don't see anything and I like it at the end of the day, this would be a pretty good candidate for me today towards the last 10 to 15 minutes for a possible trade. I took a brief look at it. There was pressure in the space today. I didn't see specific pressure in the name itself, but that's kind of the process I'll go through. Once again, I don't do a lot of intraday trading, but I will do more trading towards the end of the day. Are there any specific questions about these portfolios? I should introduce one other concept. It's entry low and entry high. So what you don't want to do is you don't want to chase your entry points. And everything is explained right here. If you just click on the question mark, it'll give you that entry range, which is down 50% to up to 30% of volatility itself, and then your exit range is going to be up 2% on a sliding scale. What you will often see with these names, especially the momentum names, you'll see these moving in waves. And what I mean by that is, one day will be just a poor day for momentum names, and then perhaps the next day it'll be a wonderful day for momentum names. So you'll see those things moving in waves. And just one word of caution, I guess, is just be aware of the intraday volatility. I tend to find myself being a little bit more comfortable, 5, 6% range. It can get a little dicey sometimes, when you get 10, 11, 12% volatility, because you can have days like this where all of that volatility will fall out the other side. So just be aware of that. Let's see if there's anything else that I was going to talk about that. I think that was it for that one. Our model portfolios, give you a quick update in regards to our model portfolios. So what this is, you're looking at the Edge Focus Momentum portfolio right now. So every day, email comes out to subscribers, and you can get on the subscription list by sending me or Tim an email. We do ask that you be a regular subscriber, though, and not just a trial subscriber. But every day you'll get an email. It'll tell you what we're moving out of that day. It'll tell you what we're moving into. You can see the year-to-date performance right now for Focus Momentum up north of 8%. So it's doing really well. Specifically, it's been the last week or so where it's really started to gain some traction. So middle of the month, we were up about 2% year to date. And over the last 7 to 8 trading days, we're now up 8%. We're going to give a little bit back today, but I mean, you can see that performance 8% versus 1.7 for the S&P 500. This is what the chart looks like right now for the Focus Momentum. Let's take a quick look at low volatility. Very similar dynamic. You can see that we were up about 2% middle of the month. We actually moved a little bit lower. We're break even, and now that's quickly moved up to about 5% once again versus 1.7 for the S&P 500. And here's what that chart looks like. Are there any questions specifically in regards to that particular topic or anything so far? I'll stop sharing here for just a second.
I think you're good so far.
Okay. We'll continue then. At any point in time, feel free to let me or Tim know. You can contact us via email if you have questions about implementation.
Yeah,
or especially,
where are you going?
One thing that might be helpful, because we were chatting about this with a user, is you can say, look at TSM in that portfolio and say, well, how come it still holds that? Because demand is declining. So there are 2 exit criteria for the Focus Momentum portfolio, and it wants to buy rising demand and it sells falling demand. And you look at TSM and say, well, isn't it fallen? Yes. The other criteria would be when the 5-day trend in short volume rises. That's not true at present, but we're also constraining the turnover. We're trying to minimize turnover, and the model will prioritize turnover based on market cap. So it might end up holding TSM longer, even though the criteria have been hit, because it's supposed to have a minimum of 4. And our whole thinking is to try to tamp down the amount of turnover. There's a lot of turnover, but again, we're doing the same thing that ETFs do, really. That basket is constantly changing. It's one of the things that Mike Green talks about, that they're not passive. They're constantly reconstructing the basket. And if you're following math, that's what you're doing. And when the math tells you to do something, you do it. And so it's an explanation for why you might see that periodically.
Sure.
Okay, so
thank you. Yep. So that was just a couple thoughts as it relates to, let's call it daily trading, whether you want to use the daily trading ideas or whether you want to use the model portfolio. We give you a couple of different ways that you can accomplish that. Let's review just a couple of, let's call it, current conditions in the market right now. And we'll start with where we are from a sentiment perspective. And recently, we've been doing exactly what we would suppose would happen under these conditions. And let me show you what I mean. So we went above the red line about a week and a half or so ago. When we went above the red line, we were roughly at about 692 on SPY. When we came out the other side, where were we? We were at 692. That is what tends to happen above the red line. Historically, uh, we're above that red line. Just think of it as kind of stretched, maybe overbought conditions. We tend to be above that line for about 8 to 9 trading days on average, and the gains during that period, 50 to 60 basis points. And you can see it playing out over here. We went above the red line back in early December. SPY was roughly 686. When we went back the other side, we were down to 681. So you tend to, everything just tends to slow down a little bit. The market doesn't tend to implode. But here's one other consideration, and I was looking at this shortly before the meeting. And let me take you to a spreadsheet that I have. Those that are familiar with these calls know that I come to this spreadsheet once in a while. What this is looking at, and don't worry, I'm not going through all the details. It's just looking at what the performance was during periods when we were above the red line, and then the performance 2 weeks afterwards. So in other words, when we slip back below that red line, what happened to the market? Did it continue to go up? Did we have issues in the market? And here's a general principle that I found right before the call. And once again, this is general principles, but generally, if the market was trading higher during that red line period, it tends to trade higher afterwards. It's not true all the time, but if you look at periods where we had a lot of issues, and I'll take you to 2022 for an example, this was a bear market, and you can see that everything was playing out in a very similar manner there. When we went above the red line, it didn't make a bit of difference. The market was just performing poorly. Guess what it did afterwards? It performed poorly. But what generally happens? Well, if the market's higher during that red line period, it's usually going to continue higher afterwards. And once again, historically, we're looking at that's for performance over time, about 60 basis points. Guess what the performance is afterwards on a 2-week average? About 60 basis points. There are outliers, of course, but that's generally what the market has been doing over the course of the last 6 to 7 years. We talked about this concept. The next one I want to cover is a concept that Tim talked about I think it was during this meeting last week, and then I mentioned it in the note last Friday. It's the concept of the market just really working in waves, and I already mentioned it with the momentum portfolio. You see these waves over time. I just wanted to show you what's been occurring from a short volume perspective and the waves that we have been seeing. So what you're looking at here, for those not familiar with it, market structure sentiment, that's our demand algorithm, is here in green. SPY is up top in blue or gray, and down below is short volume. And what I wanted to point out is what's happening with these short volume waves. So in general terms, when short volume has been declining recently, it kind of consolidates broad market performance. When those short volume waves, when the shorts get covered, what does that mean then? Well, there's less supply in the marketplace, and watch what's been happening. We get a rally, so we get a rally there. What happens here? Well, everything kind of fizzles out a little bit. What happens when shorts fully get covered? We get a rally again. Look at this period through here. Shorts get covered, and the market rallies. And you can see these waves that are playing out in the market. Once again, mid-December, shorts totally get covered, market rallies. Where are we right now? Well, shorts went down, market kind of faltered a little bit once again, short volumes once again starting to move higher. So it's these concepts of moving in waves. I mentioned this in this morning's note. It's a little easier to see when you're not just looking at an email, but look at the inflection points here. So options expirations, that's the green squares here. down into expirations, up afterwards, down into December expirations, up afterwards, down into January expirations. And this one was extended because volatility expirations was the next week. What happens afterwards? Up afterwards. So, clear patterns in the market here during the course of the last 3 months or so. And, maybe this next month we won't have that same type of pattern, but recognize that these patterns play out in individual stocks and they play out from a sector perspective as well. A couple of my clients on the investor relations side, we see it repeatedly in energy stocks, and I think I mentioned this in a previous call. You'll see changes in strategies, and they tend to line up with options expirations. There's probably a few other sectors that has that proclivity as well. One other item to note here is recent month-end activity. So month-end, historically, you could you could almost go to the bank on it a few years ago. When you got to the end of the month, no matter what was happening, when the new month would hit, you would get what we call a new month, new money trade. And that's the tendency of market participants to put money to work at the beginning of a new month. Well, that trade hasn't worked quite as well recently. There's the end of October. What happens afterwards? A little bit of pressure. Here's the end of November. What happens afterwards? Not a whole lot. We would say December, it did work. Did work for about a week and a half or so. But that has been hit or miss here during the last few months. Let me see if there's any other item I want to cover. Let's take a peek at big tech conditions, and this will kind of dovetail with one of Tim's topics because he wants to talk about some of the recent earnings trends, and there's obviously been a lot in big tech. What I wanted to share with you, obviously Microsoft under a tremendous amount of pressure today, but where are we from a big tech perspective? Sentiment is starting to trend a little bit higher now. It bottomed at right around 4. That's ticked up to 4.3. Where are we from a demand trend? Well, none of the big tech components are actually declining right now. They've either bottomed or topped, or they're moving higher. Is it a wonderful setup? No, because we're below neutral. You right away you get a hint that it's not a fantastic setup, but neither is it terrible because once again none of these are declining. So we'll have more to say to that, especially as we take a peek at the path ahead. But Tim, I think with that, I will turn it over to you.
Okay, thank you very much, Brian. And Joe, I'll try not to forget your question because I think that's it. Just jump in and remind me if I do, because I'm getting old. I could 2 minutes from now I could have forgotten what I was going to say. But I want to talk about your point regarding broad market sentiment, which is a composite of the 500-ish at any given time. It could be 504, could be 498. Whatever the S&P 500 has decreed, and we license that data. As our broad market sentiment read versus SPY, which spends most of its time at 5. And we'll talk about that. I want to answer that question because I think it's a good one. My topic, so I've got 3 things on the list. I'm going to share my screen and I'll come to you, Joe. I'll come to that question in just a moment here. So what I was, I'm going to go back. It's always a little bit embarrassing to say, well, to quote myself, to go back and refer to something that you yourself have said. But I'm doing this because it's a pretty good reminder. The data we're tracking isn't perfect, but I get a lot of notes from folks about how we'll have tried this thing, that thing, the Chaikin money flows, MACD, RSI. And none of it seems to work. And I always say, well, the problem with many of those tools, and I'm not knocking them, I'm just saying that the reason they're often not better than a coin flip is because they don't reflect the way that the market works today. I think if you have a tool, it better reflect regulation national market system. The way that the market works, demand supply volatility under Reg MS is diametrically opposite of the way that the market worked for the 200 years before that, all the way back to the Buttonwood Agreement in 1792. From 1792 to the year 2000, the market basically worked the same way. Then we had decimalization, changed the way that we distributed and shared data and monetized it. It was a property rights case that went to the Supreme Court because that data belonged to the exchanges. And here we have a consolidated tape all of a sudden. So you have to realize that the things that you use have to reflect the way that the market works now. So our erstwhile partner, IBKR, and we're working on somebody else, our content is still out there. And I'm going to reference a couple of things because it's telling how accurate this was. So I wrote a piece for IBKR on October 7 about what volatility tells us is coming next. And Brian noted this. He said, I think yesterday, you look at the volatility in SPY and he'd say, well, we're about to have an event. And son of a gun, it was correct. I don't know what the market's going to do. It's another thing I'm going to talk about, 0 days to expiration options. We noted this. I said, and you can go look these up. All you have to do is go Edge, IBKR at Google, and it will take you to this content and you can go still find them out there. But what I noted was this, it's been at this particular point, it had been the longest stretch without a move of volatility in SPY of more than 1.5%. And because of the way that the market works, John Cook, user, he and I talk about this all the time. Volatility is an inherent contradiction for the stock market. The volatility is a product of changing prices, and prices change because the demand for something exceeds its readily available supply. And the irony is that all the money flooding into the market from ETFs and index funds needs low volatility, less than 2%. Got to track the benchmark and not have standard deviation in your model of more than 5%. The two are related. What's that going to do? If company reports results and the stock soars, now you've got imputed volatility. The money is naturally going to try to find size and lower volatility, and it leads to concentration in the market. But then if money wants to get out of that stuff, what's it going to do? It's going to create volatility. It's why it's central to what we do. We say demand, supply, and volatility are the way that you can trade the market. Something's down 10%, you go, holy cow, I'm going to avoid that. Well, not if its volatility is 11%. All it did was move its volatility. And if there's a demand supply imbalance, like Brian pointed out, can be an opportunity. We talk about the 1, 2, 3 rule, that the SPY or things similar to it that track the market tend to move about 1%, not exactly, but close to it. The basket, S&P 500, 90% of market cap, moves 2%, a little bit more. And then to get 3% returns, that's why we always say we want to take 2%. Why? Because all we're doing is taking the return of the market. And we increase the probability that we can do it by understanding how much things move. But it all comes back to understanding the mechanics of the market structure. But that's what you do. And if those things start to break down, we all know it. If SPY all of a sudden has 50 basis points of volatility, it is probable that money wants out. Why, you would say? Because the volatility goes away when the machines they're setting the bid and offer go, whoa, I can't seem to get any movement. Keep narrowing the bid and the offer, and nothing happens. Well, that tells you something. Whatever was flowing in has ceased flowing in, and what will happen next? It's very much like the cycles that we follow. There are demand, supply cycles, tops and bottoms, 11 days. It's 11 days from demand tops to demand bottoms over the trailing year. And we know how much you should get. And what's the probability if the market moves a lot more than what Brian pointed out? If it's 50 basis points all the time, and all of a sudden the market goes up 150 basis points at a market top, what is the probability of a volatility event? Very high. They're things that as you do this, you'll come to understand are pretty basic. That if you're looking all the time at 1, 2, and 3, I mean, is SPY moving 1%? No, it's down to 50%. What's 2 doing? And what's momentum doing? You can begin to get a very good sense, and that way you don't, believe what you hear about, well, the market's about to take off again. If you look at the data and go, no, demand is topped in the market. The market has gone up way more than it always does. Supply is rising. What's the probability that there's going to be a step down? I don't know what's going to happen today. The market is doing exactly what it does with 0 days to expiration options. And I'll lead into that to that topic. Look, I don't know everything about those, but I've read a very interesting article from the folks at Numerix, Numerix. They're quantitative data providers. It was at Tab Forum. You can subscribe to Tab Forum. It's free. We read it. I've read it for a long. I know Larry Tab, the guy who created that. He's now at Bloomberg. It's very interesting. What they said is what's happened is the market is no longer a good barometer for economics or corporate fundamentals because so much of the market's activity has come back to delta and gamma hedging for an instrument that has a shelf life of a day. Well, look what the market did today. And they point this out, that at the beginning, there's tremendous tumult until at some point, the parties that are long and short it flip-flop. Because it's all about what happens into the close. And then suddenly the market stops falling and it retraces. I don't know what will happen in the close because that's not happening. But we've gone from down 100 points on the S&P 500 to down 40. That isn't fundamental. It is delta and gamma hedging on a colossal $1.5 trillion scale. It's why I think it's going to break. It's why I keep looking at those points and going, okay, at what point are the losses for whoever's on the wrong side enough that they withdraw? I've always said that what will break the market is a break in that arbitrage mechanism. The stocks, the ETFs, and the options associated with them, they all have to stay in the same range. What happens if they don't? Well, somebody loses and somebody wins. But it's kind of binary. Or flows change. We have all this money coming into the market. If it stops, that whole construct begins to deteriorate. And so that's why we are very carefully watching this demand-supply relationship because that's where it manifests. And again, I don't know everything about those, but I understand that that is playing out all the time. That 0 days to expiration option construct causes the market to mean revert. And don't try to play it because we do not have that. We're going to get beat. Much better to know what demand and supply are telling us so we can be positioned 1, 2, 3, 4, 5 days out or whatever, right? How would you know whether to be long or short the market today? You would not know. You have to have a much better view of the demand supply trends and how long those last. And I feel like, can we do better? Well, of course, but we have a very good handle on those things. And so I wanted to point that out. One other little thing I said, this was September 29, the biggest change since 2018. That's why we watch those things. And, I've said again here in September 29, ahead of the October tumult, if you look at the data, the last time this occurred where we went this amount of time being positive was in 2018. And then what happened? So we're tracking that stuff all the time. And again, it was a pretty good, signal about something that's going to come. So we're always trying to be ahead, right? We don't have a crystal ball that will tell us the future, but we have data and patterns that can give us a good idea of what things look like when A or B begins to occur. And I'll point out here, we have gone 195 days without a break below 4 in the basket called the S&P 500. It's a very long time. The only other time was from February of 2021, I think it was, to December of 2021, was 208 days. And that was with this. If you looked at the money supply, this is M1, all the cash. So we went from, in 2020, about $4 trillion of currency.
I could have went and found that.
And then here, we went to $21 trillion. That's what happened, right? So that's why you have that very long run. Well, we don't have that this time. So, do I think we're coming to the end of a cycle? Well, I do. No one can say for certain when those things will occur. But that fed that long cycle. What fed this one? AI fed this one. And is AI as big as 16 trillion? Maybe it is. Maybe it is. Anyway, the last thing I want to talk about before we get to what's ahead are these earnings. That is, and Joe, I won't forget SPY versus the basket. If you looked at big tech, let's just take Tesla. I'll go through, I think, four of them. And if you say you were looking at this and saying, well, what would you expect from Tesla? Well, it's here on the 20th of January at options expirations, I would say everybody bet long. Why? Because options reset here and short volume was way down from where it was here. Um, and demand's at 5. Is that bad? It's not bad. It's not bad. It's not awesome. I could show you awesome. But then it began to rise. And so, you can see right away why Tesla, it's fine today. In a pretty tough day, it's down a little, but it's not bad. But am I going to buy that? Well, not if I see this, right? If the supply side's rising, could it be feeding demand? Yes, but I just don't like that relationship. If you looked at Meta, would you have known that Meta was going to pop? Well, not really. I look at this data and say, do I like it? Candace, it kind of gets to would I buy rising demand and rising supply? I won't do it. Now, in that instance, it worked out, but you could just as easily have the opposite outcome. This is the problem when derivatives are playing a key role and there's leverage and we just can't see all that, right? So if you were to, to pick Microsoft, I mean, it looks almost the same. You could say, well, demand bottomed here and it was rising along with supply ahead of results. Would anything in here tell you it's going to drop 12%? No, but there's weak demand. I mean, I think weak demand is challenging. You don't know what it's going to do. I'm certainly not buying that. But could I tell you that it was going to do that? No. If you looked at Carvana, this is not big tech, but I find it interesting because of it's now out of the top 135 largest stocks. Would I have looked at that and said, I'm going to buy it? No, it wasn't bad. I mean, you got demand at 5, but it's coming off a 10. So again, you got weakening demand. Something could very easily go wrong. I couldn't tell you with this stock which way it was going to go. I would certainly say, well, it was 69% short January 27. I'm not buying that, but I could not have possibly told you it would drop 14%. Wouldn't have known. It teaches you two things. Demand and supply are very telling. They will tell you a lot. They will not tell you precisely what's going to happen with earnings. Okay, I think that's all I've got. If we want to go to this, your point, Joe, we'll just take a minute or so to talk about what's the difference between SPY and the basket that we track up here in broad market sentiment. SPY is a proxy. It is a perfect proxy for a market that is heavily concentrated in what's called large cap blend stocks. The S&P 500 is comprised of, generally, I mean, you could say, well, who's the smallest component? AutoNation, maybe, around 8 billion in market cap. Who's the largest? Whatever it is. Is it NVIDIA? Maybe. Anyway, it's going to give us large cap blend is value and growth. If you were to average 10s with 5s, what would you get? Well, closer to 5. The whole point, though, is that 5 reflects a blend of value and growth stocks, stuff that spends a lot of time at the benchmark. SPY is the benchmark, but it's a representation. So it doesn't have the swings up to 10 and down to 1 that you're going to see in a basket of stocks, because it's very liquid. SPY is. The SPY is created and redeemed continuously. ETF creations and redemptions average almost $900 billion a month, because you create ETF shares for people to have access to the market. And when they sell, then you gather up ETF shares and you remove them. Creations, redemptions happens all the time. So we look very closely at the amount of time that it spends at 5 before breaking down. It broke down here. Has not broken down since. It might be the longest stretch now in the entire data set back to 2017. That's as far back as we can go with apples to apples data. We can tell you that exactly the same data existed in 2017 minus whatever changes. So we have an apples to apples comparison. It's interesting that here, very low short volume during this breakdown, we're having that. I don't know what's going to happen, but you look at that and say, well, is that just going to continue on? Not forever. but it's distinct from broad sentiment where you have all these different stocks comprising the very same measure, the green part of the line. So you're going to get a lot of fluctuation in those components because they are value and growth and everything else that's in there. So we use the price of SPY as a price proxy, but then the underlying demand and supply of the stocks as demand and supply because it's a better representation of reality. I watch SPY. I look at it and check the demand supply relationship routinely, but that's the difference. Okay, what's ahead, Brian?
Tim, a couple quick questions for you before we kind of go ahead. Question from Joe. If that Microsoft demand that you showed earlier was 7 instead of 3 or thereabouts, would you consider buying it with stronger demand?
If the supply was moving the other way, much better bet. Yes. Not saying I'd take it because I'm just queasy about trading around earnings, but that would be a much better setup. Yes.
Mm-hmm, mm-hmm. And then one other thought from Anesh, just thoughts on gold and
Anesh.
commodities right now.
You know, it's so difficult, Anesh, because we don't, we're not tracking metals. We just track equities, and I could look at my gold set of just 4 securities and would it be a good indication of what gold's done? Yeah, I guess. There's been unremitting demand for them, but to me, these are all part of this. I mean, Bitcoin, AI, gold, silver, they're all a product of this juxtaposed with this. If you were to take the velocity of money versus its supply, they have reversed. The way that you get economic outcomes from money is that I spend money with you and you spend money with somebody else and that person invests it and and that's how you get velocity in money. Well, when you oversupply money, the velocity plunges because the prices aren't a reflection of economic activity. Ergo, what will they do? They will go into stores of value, Bitcoin, stocks, bonds, art, real estate, gold, silver. And at some point, this means everybody's out of money. And then somebody will go, well, I need to sell some real estate and raise some cash, except everybody's out of money, right? So then the prices all have to reset. And then the central banks will offset that by trying to flood the system with money again. To me, these are consequences. They're very clear indicators that we are, no one knows where we are in the cycle, but we are at this frenetic, tulip bulb mania point in the cycle to me. But someone else smarter than me will have a different opinion. So what's ahead? Brian, you want to do your, I can do my 30 seconds. My 30 seconds is
Okay.
I'm
Yep, go
watching
ahead.
this cycle. We're at 5.8 demand and supply is rising. And I am confident that one of those things that Brian pointed out, those cycles, it's been repeated. You go back to August. First happened August 1. Options expiration, sudden volatility and a recovery. And then another one, September, not quite as big. October, wham, man, did we take a shot. November, massive hit, big volatility, one of the 6 largest vol of vol days back to 2017. December was better. January, I don't know what's going to happen here. The NASDAQ's down 308. I mean, does it fall off the cliff in the last half hour? No, I don't think so, but options expire tomorrow. I think one of these is the end of the cycle. I just can't say when. So I'm very careful here at these tops. I think you can trade momentum well. Our model portfolios have resumed doing after that weird period that I think reflected those volatility spikes, where it didn't perform well, both have resumed performing well. And those are great ways to approach the market to me. Again, it's data, not advice. But I am concerned that one of these is going to be a problem. And we're going to have a major volatility event because of the discordance between the market's need for low volatility and its absence of liquidity to satisfy that demand. But Brian, what thoughts have you?
Yeah, thank you, Tim. Before we get there, one question from Richard, whether we are in the momentum portfolios right now. And I can start with that. Richard, I was actually looking at that right before the call. And I'm not right now. And I was looking at what would bring me back in. I was looking for a period of, let's call it stabilization, and specifically from big tech. I like to see big tech and the broad market in alignment. And what I mean by that is both kind of moving the same direction at the same time. And obviously, big tech has been under a period of weakness. Is it stabilizing now? Obviously, we're seeing the weakness in Microsoft today, but perhaps we get a little stabilization. If we do, then yes, I would be going back in.
Sorry, I'm going to try to find that 0 days to expirations piece. Let's see here. It's at tab forum.
And
Yeah.
yeah.
Go ahead, Brian.
And I think you can get there with the link that I provided. You just have to sign up for a free.
Oh, there it is.
Free
Okay,
one
good.
there.
Thank you.
Yep.
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 Yeah, that should take you to the article. Good. Good. Yeah, I thought they had some good conclusions. So,
Yeah, I'll quickly go with my look ahead. Sentiment is above neutral. In general terms, if sentiment's above neutral, it supports equity prices. But I'm looking once again at big tech. Do we get further stabilization there? Does it continue to move higher?
and to kind of to tag onto something, Candace, that you said, I pointed out that you look at the big tech demand supply equation. It's not something I would buy. I prefer to buy divergent demand and supply, and they're both moving the same way. Again, doesn't mean that it won't work out, but those are just, if you're going to follow something, you might as well stick to it. There are always exceptions. I just stick to the central tendency. My central tendency is always rising demand, falling supply. It's the highest probability outcome. It doesn't mean other combinations won't. There are always exceptions and edge cases and times that things behave differently than you anticipate. But to me, those conditions are difficult to find right now. And so when they are difficult to find, I tend to be cautious. But it's my nature. So we'll see. I think tomorrow is an important, who knows, right? An important month-end expirations date. And then, as Brian said in his note, we've got new month, new money. Is that going to happen? Are people putting more money to work? Or is this Microsoft outcome going to cause people to go, I wonder if we're overinvested in AI? We've had those conversations before. I don't think of the market as driven, fundamentals are an input, as are as our mathematical flows, as is the behavior of Citadel and all the market makers, the speculation on metals. All of these things are inputs into the market. It's not one thing; it's all of them. And which one thing that changes is the thing that changes outcomes. I think people are too fixated on the fundamentals and not focused enough on, to me, the mechanics. That the mechanics of the market is where you will have the greatest touch point for understanding risk, because they're so massive. And so that's what I'm looking at.